The markets are dumping on this stock. So in today's video, I'll be covering a few things. We'll be covering the compounder that is crashing today, some stocks that I'm considering, as well as some questions left in the comment section below. So let's talk about this stock, which is FICO. FICO today is down around 15%. It is currently trading at around a 66 to 68 times earnings, and it is near its 52-week low as well. So why exactly is FICO crashing? FICO is crashing because Bill Putte, which is your head of FHFA, he came out and said that Fannie Mae and Freddie Mac will allow lenders to use the Vantage 4.0 score with no current requirements to build new infrastructure. So basically what that means is that your lenders can choose between the FICO Classic score and your Vantage 4.0 score. So they can choose which one they want to use, and they can substitute the current FICO Classic score with their Vantage score itself. So FICO Classic is actually mandated for Fannie Mae and Freddie Mac, your home loan government-sponsored enterprise in the US itself. So around 35% of FICO score revenue comes from companies like your Fannie Mae and Freddie Mac. So now that Vantage score is basically approved, consumers and lenders have the opportunity to go and choose between them. So previously, it was mandated that only the FICO Classic score will be used in your Fannie Mae and Freddie Mac. But now that Bill Putte has come out and said this, your consumers and your lenders, they can switch to your Vantage score instead of relying on the FICO Classic score. So let's look at some assumptions here. So FICO's current score revenue is at around $1 billion. So assuming 35% of that comes from your mortgage loans, and 70% of that comes from your government-sponsored enterprises, $245 million will be impacted, so $245 million worth of revenue. If they lose 1/3 of their market share, there'll be a 33% hit to their revenue, which is around $83 million. So $83 million at 88% operating margin, that is a $73 million operating income loss for FICO. So that's around $55 million in terms of net income being hit, which is around 10% of their current net income. So this is the base case assumption for FICO. If they lose around 33% of the current market share, then they'll have their net income being hit by around 10%. So for Vantage score, it is growing rapidly as well. So Vantage score usage has grown around 55% in 2024, for example, to an all-time high of 42 billion credit scores. So Vantage score is actually owned by your three credit bureaus, Experian, TransUnion, as well as Equifax, and they are more incentivized to basically push out their own score and the usage itself. And this is overall a positive for your credit bureaus. So now that FICO is not protected by regulation, their scores are now in direct competition with Vantage score. And this could be the start of the decline of the moat in FICO itself, because now that lenders have the opportunity to basically switch to your Vantage score, it will reduce the pricing power that FICO can exercise as well. So there are some counter arguments to this as well. So FICO score is deeply embedded into the mortgage system in the US, that lenders will unlikely switch. So lenders, what they do is they prioritize risk management rather than the consumer's cost. So they will likely still pick FICO score instead of the Vantage score, and the Vantage score will basically just be a supplement to the FICO score itself. So FICO's price increase have come in a time when the housing market is weak. So we could see a normalization in the housing market, which leads to less price hikes being needed to sustain the growth for the company itself, and that could be a tailwind for the stock. So for FICO's valuation, it is currently trading at around $1,500. So assuming a 40 times earnings for this company and a 15% EPS growth, the CAGR over the next 5 years is around 4%. So clearly the stock is currently still overvalued, but let's apply a more base case assumption for this one. So assuming a 50 times earnings for this company and assuming a $1,400 price at 15% EPS growth over the next 5 years, this company will give you around a double-digit return. So if you apply a more bullish assumption for this stock, a 50 times earnings, then this stock will give you a double-digit return over the next 5 years. I don't feel comfortable with a 50 times earnings assumption for any given company, but for this company, FICO, $1,400 a share could look interesting as well. So the real winners from this announcement are your three credit bureaus, Equifax, Experian, as well as TransUnion. So your FHFA have announced in the past that they'll be incorporating both the FICO 10 score as well as your Vantage score for Fannie Mae and Freddie Mac, so both scores need to be used, and that could be an extra tailwind for your Vantage score as well, because they're getting a free push by the government itself to grow the business even more. And Equifax is an interesting company with their work number portion of their business and this Vantage score inclusion. So overall, this is bullish for your three credit bureaus. Next portion, I'll be talking about stocks that I'm considering. So for reference, this is my portfolio today. I have companies like Meta, MSCI, Microsoft, MasterCard, Pool Corp, S&P Global, Amazon, ASML, United Health, Visa, Google, Moody's, and a large proportion of my portfolio is actually in cash today. So the first stock that I've considered is Alibaba. So Alibaba year to date is up around 28%. It is currently trading at around a 15 times earnings, although if you were to normalize it, it's actually trading at around a 17 times earnings. So for Alibaba, this is the bull case for the company. So number one, it will be your China consumer recovery. So over the past few years, the Chinese consumer has been extremely weak because of the housing market crisis over there. And so if we were to see an increase in consumer activity there, then this could be a tailwind for Alibaba. The management is also pushing towards its core businesses and they're divesting all their weaker businesses and reducing a stake in non-core businesses like Ali Health and so on. So I think this is a good move by the management itself. They have highlighted over the past few quarters that they're focusing more on the ROIC of the company, which I think is a positive by the management itself. But this is why I'm reluctant on Alibaba. So the company faces intense competition from other companies like your JD and Pinduoduo. It is sort of like a price war currently, so all of them are lowering prices to gain share. This is weak and it will hurt their margins over time as well. And the cloud portion was also a price war in China. So Alibaba, they actually lowered the prices on a lot of their products to gain more market share there. And they're growing a lot slower than competitors like Huawei and Tencent as well. So this is signaling weaker demand and weak pricing power from this company, which is why I'm slightly reluctant on Alibaba. The company is after all still a retail business, and the competition that the company is facing today could hurt its returns over the next few years. Next company that I've considered as well is Canadian National Railway. So this company is up around 2% year to date. It is currently trading at a 20 times earnings, giving you a 2.47% dividend yield. So for Canadian National Railway, it is a predictable business that will never run out of business, but the problem is the slow growing element of the business itself. So it will be a company that gives you around 10% returns over the next 10-20 years, likely around market returns when it is fair value. So I don't see a reason to buy into this company today unless it is extremely undervalued relative to the markets, because the markets will likely give you around 10% returns as well. But I'm looking for opportunities to deploy the cash, and this is a company that I'm actively looking into as well. So the next company is MSCI. I own this company already. It is currently around 3% of my portfolio. This company year to date is down around 2%. It is currently trading at a 39 times earnings. So for MSCI, it is the stock that I'm closest to adding in my portfolio with that valuation today. It is historically cheap, and the company will see 11 to 12% revenue growth every single year, with 13 to 14% bottom line growth, and stable earnings and free cash flow as well. So for MSCI, I view it as a high quality business, one of the best businesses out there, without regulation risk as well because they're not a complete monopoly. And this is a stock that I'm actually considering increasing my stake in, but the price today is still not compelling enough yet. Last portion, I'll be talking about some questions left in the comment section. So this first comment over here is actually about Multi. It says, just curious, how is this a good pick if it is not riding on a mega trend? Where is the liquidity and the total addressable market growth going to come from? I agree with the points of how it is hard to displace Multi as the go-to prestigious drinks for gifts due to irreplaceable nature of the taste of the drink. But how much more TAM does it have to grow? Are more people outside of the Chinese market going to view Multi as a premium drink and adopt a similar approach as the Chinese? A CAGR of around 7% shows a solid business model, but I wouldn't consider it disruptive or special. So this comment is talking about Multi and how the TAM is not going to grow. But if you have to look into the numbers itself, Multi sells around 60 million kg of their drinks every single year. So I did some math with it, and assuming everyone drinks around one bottle of Multi, that would equate to around 8% of the Chinese population drinking one Multi every single year. So the total addressable market is still definitely there for this company, along with the price increases as well. So a 7% revenue growth with that price increases will be around a 9 to 10% bottom line growth. And adding on to the dividends as well, this company could easily be a 13 to 14% CAGR over the next few years. So I think the 7% revenue growth for this company is more than sufficient for you to get decent returns from this company. And assuming they can keep increasing the prices, there won't be a problem for Multi in the future to increase their revenues at this rate. Next comment it says, I want to know about Berkshire Hathaway. It is currently trading at $480. It's lower since the tariffs were announced in April. Do you think it is a great time to buy? What are your views? So this is what management has done with the stock itself. Management stopped buybacks in around August of last year. So the stock back then was trading at around $400 a share. And currently the price to book of Berkshire Hathaway is at around 1.5 times. So historically, if you have to look at the price to book valuation itself, the company is trading at a premium relative to its history. So for now, I don't think Berkshire Hathaway is trading at a discount. I mean, the management has stopped their buybacks because they don't think the share price is reasonable at this price. And if you have to value Berkshire at a price to operating income, this company is trading at around a 20 times price to operating income. So that will equate to around a 25 times price to earnings. So I don't think buying into the stock is a problem. But of course, the management clearly thinks that the stock is expensive today. I hope you guys have found this one useful and invest safe.